In the world of finance, there's a secret language that might seem intimidating at first glance. It's the language of financial statements. Just like any language, once you understand the basics, it unlocks a world of understanding. Financial statements are reports that companies use to tell their financial stories. They paint a picture of a company's health, performance, and potential. We're going to explore the three main financial statements: the balance sheet, the income statement, and the cash flow statement. Each statement provides a unique piece of the puzzle, offering a different perspective on a company's financial standing. Think of it as a financial detective's kit, with each statement providing clues to help you unlock the secrets of a company's finances. By the end of this video, you'll be able to navigate financial statements with confidence, identify red flags, and spot opportunities. Whether you're evaluating a potential investment, assessing the health of your own business, or simply want to expand your financial knowledge, this video is your essential guide to understanding the language of business. Get ready to unlock the secrets hidden within financial statements and gain a competitive edge in the world of finance. Let's empower you with the knowledge to make smarter, more informed financial decisions. Liabilities and equity at a specific point in time. The income statement tells the story of a company's financial performance over a period of time, usually a quarter or a year. Finally, the cash flow statement tracks the movement of cash flowing into and out of a company over a specific period. It's like a financial GPS, tracking the cash flow through the company's operations. Let's start with the balance sheet. It's called a balance sheet because it always balances. Assets must equal liabilities plus equity. Think of it like a simple equation. Assets equals liabilities plus equity. This equation is a cornerstone of accounting, and it's essential for understanding a company's financial position. Assets are things the company owns, like cash, inventory, equipment, and property. Liabilities are things the company owes to others, like loans, bills, and salaries. Equity represents the owner's stake in the company. The balance sheet gives you a snapshot of a company's financial stability. A healthy balance sheet will show that a company has enough assets to cover its liabilities and isn't relying too much on debt. Now let's move on to the income statement, also known as the profit and loss statement. This statement tells you how much money a company made or lost over a specific period. It follows a simple formula. Revenue minus expenses equals net profit. Revenue, also known as sales, represents the total amount of money a company earned from its operations during the reporting period. Expenses are the costs the company incurred in the process of generating those revenues. The bottom line of the income statement is the net profit, which is the profit or loss. A balance sheet is often described as a snapshot of a company's financial health at a specific point in time. By carefully examining the balance sheet, we can gain valuable insights into a company's financial strength and stability. Remember the basic accounting equation: assets equals liabilities plus equity. This equation is the cornerstone of the balance sheet. The balance sheet is divided into two parts: assets on the left and liabilities and equity on the right. The assets section lists everything the company owns, while the liabilities and equity section shows how those assets are financed. The balance sheet is organized in a hierarchical structure, with the most liquid assets at the top and the least liquid assets further down. This arrangement helps us understand the company's ability to meet its short-term obligations and its long-term financial health. Assets are the lifeblood of any business. They represent the resources a company uses to generate income and profits. Think of assets as the tools, equipment, and resources a company needs to operate and grow. Assets are generally divided into two types: current assets and non-current assets. Current assets are assets that are expected to be converted into cash or used up within 1 year. These include cash and cash equivalents, accounts receivable, and inventory. Non-current assets, also known as long-term assets, are assets that are expected to provide economic benefits for more than 1 year. These include property, plant and equipment, intangible assets, and long-term investments. Liabilities represent a company's financial obligations to others. These reflect the different ways a company finances its assets and operations. Liabilities are divided into current and non-current liabilities. Current liabilities are obligations that must be paid within 1 year, such as accounts payable and short-term loans. Long-term liabilities or non-current liabilities are obligations due after 1 year, such as long-term debt and pension obligations. Understanding a company's liability structure is crucial for assessing its financial risk. A company with high debt levels may be more vulnerable to economic downturns or changes in interest rates. On the other hand, a company with a manageable debt load and a healthy mix of short-term and long-term liabilities may be better positioned to weather financial challenges. The balance sheet provides a complete snapshot of a company's assets and liabilities at a specific point in time. Now that we've looked at the balance sheet, let's turn our attention to the income statement. Also known as the profit and loss statement, this dynamic financial report tells the story of a company's financial performance over a specific period. The income statement follows a simple yet powerful formula. Revenues minus expenses equals net profit. This simple equation reveals whether a company made a profit or experienced a loss during the reporting period. By carefully examining the income statement, we gain valuable insights into a company's ability to generate revenue, its expense management practices, and its overall profitability. The income statement is structured in a hierarchical format, starting with revenues at the top and working down to net profit at the bottom. Along the way, it provides a detailed breakdown of the various expenses incurred by the company. It's like peeling back the layers of an onion, revealing the inner workings of a company's financial performance. At the heart of the profit and loss statement lies revenue, also known as sales. This important figure represents the total amount of money a company earns from its core business operations over a specific period. Revenue is typically recognized when a company sells a product or performs a service regardless of when the cash is actually collected. This accounting principle ensures that revenue is recorded in the period in which it is earned. For many companies, revenue is a key driver of profitability. As revenue increases, so does a company's ability to generate profit, provided that expenses are managed effectively. By carefully analyzing a company's revenue sources and growth drivers, we can gain valuable insights into its competitive position and long-term sustainability. So, we've talked about revenue, the money a company makes, but to make that money, companies have to spend money, and that's where expenses come in. We can group expenses in different ways depending on what they are and how they relate to revenue. One common way is to separate the cost of goods sold, also known as COGS, and operating expenses. COGS are the direct costs of making or buying the products a company sells. This includes things like raw materials, direct labor, and manufacturing costs. Operating expenses are all the other costs of running a business, like salaries, rent, and utilities. These costs are essential to support a company's overall operations. Now let's look at the third and final major financial statement, the cash flow statement. While the income statement gives us valuable insights into a company's profitability, it doesn't tell the whole story. A company can be profitable on paper, but if it doesn't have enough cash on hand to meet its obligations, it can still face financial difficulties. The cash flow statement fills this gap by tracking the movement of cash both into and out of a company over a specific period. It provides a clear and concise picture of where a company's money is coming from and where it's being spent. The cash flow statement is divided into three main sections: operating activities, investing activities, and financing activities. Each section reflects a different aspect of a company's cash management practices. By carefully examining each section of the cash flow statement, we gain a deeper understanding of a company's cash-generating abilities, investment decisions, and financing strategies. Let's start with the first section of the cash flow statement: operating activities. This section focuses on the cash flows directly related to a company's main business operations, the activities that generate its revenue and expenses. The primary source of cash flow from operating activities is the money received from customers for goods sold or services rendered. This represents the lifeblood of any business, the money that keeps the lights on and the wheels turning. It's crucial to delve into the details of operating cash flows. It's like taking a closer look at the engine of a company, examining how smoothly it's running and whether it has enough fuel to sustain its growth. Now let's shift our focus to the other side of the operating activities section: cash outflows. These represent the cash payments a company makes as it runs its business. Just as cash inflows are essential to keep operations running, effectively managing cash outflows is crucial for maintaining financial stability and supporting growth. Some of the most common cash outflows from operating activities include payments to suppliers for goods and services, salaries paid to employees, rent for office space or equipment, and utility bills. These are all necessary expenses that a company incurs to keep its doors open and operations running smoothly. Effectively managing cash outflows means striking a delicate balance between minimizing unnecessary costs and investing in growth opportunities. Congratulations! You've just completed your crash course on understanding the three main financial statements: the balance sheet, the income statement, and the cash flow statement. Armed with this knowledge, you are well on your way to becoming a more informed investor, a smarter business owner, or simply a more financially savvy individual. Remember, these statements are more than just numbers on a page. They tell a story about a company's financial health, performance, and potential. By learning to read and analyze these reports, you've gained a powerful tool for making smarter financial decisions.